Today's tutorial will be on international trade and we will discuss the factor price equalization theorem. So let us see what this theorem tells. Okay. Now it says trade. So this is a backstory and then we will do a little bit of graphical representation. We'll not do the entire graphical approach in today's tutorial and we'll continue it forward in our next tutorials. Now trade occurs in the world where the movement of goods and the mobility of factors are more or less termed as imperfect. Now it is common to assume that perfect mobility of factors nationally. Then you can also have the assumption of complete free movement of goods within and across the boundaries and complete immobility. So complete immobility of factors internationally. Now, under the assumption of full mobility or perfect mobility of factors internationally, so that means I am going to remove this. What happens is that factor prices, so if this happens, then factor prices would be same in all the countries. But in the world where factors of production actually cannot move between the countries, whereas we have the options that goods can move freely, trade in goods can actually be viewed as a substitution for factor mobility. So, commodity trade, so goods can cross boundaries while factors cannot. So, we are using goods as a substitution for factor mobility. So, when there is commodity trade, this will actually equalize factor prices completely. So prices completely only and only in the absence of factor intensity reversal, that is between the factor endowment ratios of two countries, and provided that neither country specializes completely in production of one commodity. So incomplete specialization in both countries is actually consistent as well as widely differing factor prices between countries. Now this factor price equalization FPE theorem can be taken as a important corollary of our HO model that has been discussed in details. Now, after knowing what the factor price equalization actually mean, where we are just substituting commodity trade for factor mobility so that we get equalization of factor prices completely, let us now look at the factor prices under the autarky situation. So I'll make box diagram. So let me draw it. Okay, and let me mark the origins. This is O dash. Okay, and this becomes. So first we will analyze a pre-traced situations or the factor prices under autarky. Now I have already drawn the diagram, so we will discuss it, so it saves a little bit of time. Now before trade, the two countries can produce anywhere on the contract curve. So your first question has been answered. You must be wondering what are the lines or the curves that I have drawn. It is nothing but the contract curve in their respective boxes. So this is very important. Now let us assume that the country 1, I have already marked it, produces at point P on its contract curve, and country 2 produces at point P dash. So after these points we have said, what is the implication for factor prices? Now you can see clearly that country 1 uses more capital intensive methods of production than country 2 in both lines of production. Now production function are same in both country and they are homogeneous. So this is the assumption of the first degree. Now we know that the marginal productivities are determined exclusively by factor intensities that are used in production. So because country 1, as it can seen from the diagram, uses more capital per unit of labor than country 2, the marginal productivity of capital at the point P in country 1 will be lower than the marginal product of capital at point P dash in country 2. Now factor prices are determined by marginal productivity. So it follows that the price of capital will be lower in country 1. So in country 1 will be lower than in country 2. So price of capital in country 2. And the return of labor, a return for labor, that is, we are talking about the wages, will be higher in country 1 than in wages of labor that prevails in country 2. And this holds when each country produces and consumes in isolation. That means there is no trade between them. Now, let us introduce the trade. Okay? We'll just slightly introduce it and then we will finish the discussion with regard to this diagram in our next tutorial. Now, so we will follow the HO model. What is the HO model? HO theorem. So following this theorem, country 1, where capital is relatively cheap, will actually export capital intensive good, and country 2 will actually export labor intensive good. Okay, and good B is actually capital intensive and good A is actually labor intensive. So this is the information. This is how the pre-trade situation looks like. Now what we will do, we will open the trade, that will mean we will remove the trade barriers and let the trade happen, and we will see that when the trade start, how the country's positions, what will be the changes that will be occurring, and this will be done in our next video.